You believe that manufacturing jobs can come back in a meaningful way?
I think some manufacturing jobs can come back in a meaningful way here. One of the most interesting stats I've seen over the past month, average salary for a sociology grad of a leading university, $60,000. And average manufacturing, $150,000. We have the ability to do high-end manufacturing here. We have the educational system to do it. We have the workforce to do it. We don't have the workforce to do everything. Low-value manufacturing, I think, is unlikely to come back here.
Yeah. All right, you mentioned hyper-exceptionalism perhaps going away, maybe forever. You also said earlier things have ground to a halt. Let me follow up on that. What does that mean, things have ground to a halt?
Uncertainty. How do you make decisions until you know what the outcomes are? And so that's what we're seeing right now. Businesses are holding off on making investment decisions. People are holding off in hiring. The decision as to where to invest, how to invest, under what circumstances to invest, the economics of investing. And I'm talking not investing in stocks and bonds. I'm talking investing in goods and in plant. Until we have resolution, until we know what the path is, I think we're going to have uncertainty. And so in our firm, as you know, our chief economist has basically coined the notion of a voluntary trade reset recession. The notion that we have had things so good and we've now ground things to a halt that it is possible we will cause 2 quarters of negative growth. Different than what I call a real recession, where lots of people lose their jobs. We still have really good underlying fundamentals.
Yeah, and obviously we got a jobs number that was quite good on Friday. Same day that you reported earnings. Let me go there if I can. I'm looking through the analyst reactions. I'd say they're mixed. Good results in a quarter where market volatility began to build. This pressures near-term estimates primarily in retirement services and principal investing. Another saying, missed consensus. FRE, though, is ahead of the street. Why are you laughing?
It's a tough job to be an analyst, to have something relevant to say on a quarterly basis.
What, in your opinion, would be something relevant to say in terms of the actual performance during the quarter?
I'd say the following. We are the beneficiary of 2 massive long-term trends. One is the growth in private markets, and private markets is experiencing very, very robust growth. From a business that was funded out of the alternative bucket of institutions, we now have individuals, we have insurance companies, we have now traditional asset managers, we have institutions who are now using privates in their fixed income and other portfolios. Lots of demand for privates. Our job is to manufacture them. Why are privates interesting? Better risk reward. We're limited by our capacity to create better risk reward, and we do this really well. So in the FRE business, we were up more than 20% quarter over quarter, very strong flows. In retirement services, we are a principal. We have to run with a principal's mindset. What we saw for the last 4 months were the tightest spread conditions in a generation, and you're offered a choice. When that happens, you can take more risk to try to keep your spread wide, or actually you can go the other way and say, this is not our time.
Right.
And that's what we did.
Sell and go to cash to some extent, raise cash.
Essentially, we built a massive pool of cash on the belief that these spreads would not continue. And lo and behold, in the first 2 weeks of April, not in the same quarter, but in a different quarter.
Did you put some to work already, or are you still waiting, given what you're talking about in the environment in terms of uncertainty?
Yes and yes. So we were, I believe, among the largest buyers. We put some $25 billion to work in April alone, and more to go.
All right, let's talk investment grade private credit, because you spent a good amount of time on the call as well answering a particular question. And I was reading various things you said, but one struck me, Mark. I think 18 months from now, we will not know the difference between public and private credit in the investment grade market. It won't be the issuers, the size, the rating, the provision of financial information, ability to sell and buy. What are you talking about?
I stand by it. The best way to get at this is really analogy. 25 years ago, the notion that loans would trade, people looked at you quizzically. Some crazy man named Jimmy Lee at JP Morgan stood up and said loans will trade. Well, how could loans trade? Every loan was private. Every loan was different. Loans took 30 days to close. But guess what? JP Morgan made a market in loans, and loans began to trade.
You started that at Chemical Bank.
There we go.
Yeah.
And all of a sudden, JP Morgan was earning widespread, and Goldman didn't like that. They made a market. And Deutsche Bank, and so on and so on. And now we have loan ETFs and loan mutual funds, and we accept that something that is not even a security trades. We're watching the same thing happen in investment grade. So we've launched with State Street a PRIV.
Yep.
PRIV is a private and public investment grade. Guess what? Private investment grade trades. People will watch us earn wide spreads. They won't like that. Others will come into the market. 18 months from now, we're going to have a market for private investment grade.